Hello. Hi, everybody. Happy Friday. Happy Easter. I see some of you joining. Hey, Gary. Hi, Tyler. Hey, AEMJ. Hope you're all doing well. I feel like I haven't live streamed in a while. So I just wanted to live stream today. Got a few things to speak about. So Ray Dalio, don't know if you guys have heard of him, but he is a very, very successful and famous fund manager. He has one of the largest hedge funds in the world called Bridgewater Associates. And we were discussing this in my Discord the other day. So I just wanted to make a video and go through his personal investment portfolio, which is really interesting. But also he has this like investment strategy called an all-weather portfolio. So I wanted to look at that as well, because it could be controversial. It basically tells you what sort of percentages of each thing to have in your portfolio. I don't know if I necessarily like it, but I'm going to share it and we can just take a look together and see what we think. So let me share my screen. Cool. Hopefully you guys can see that. Adam, my investing top is in the wash. I'll get it back on for the next one. So this all-weather portfolio, it's basically a diversified investment strategy that is meant to perform well in absolutely any economic environment. So that means if there's periods of recession, periods of high growth, periods of high inflation, low inflation, whatever's going on, this portfolio is meant to be the one to get you through anytime. So here's the breakdown of it. 30% of the portfolio, this all-weather portfolio, is into stocks. Just 30%, which for me seems quite low, but we'll get onto that in a minute. Then you have 40%, so more than stocks, in long-term bonds. An additional 15% in shorter term bonds. And then on top of that, you have 7.5% in gold specifically, and 7.5% in other commodities. So commodities like oil or agriculture, stuff like that. So that's the portfolio. Initial thoughts, let me know what you think. Do you think that that would be a good portfolio or not? The idea is basically that this portfolio will allow consistent returns in any economic environment. But on top of that, specifically, it really reduces your risk and really reduces your volatility. So I guess this sort of portfolio would be, I don't want to say it, but more attractive to somebody that maybe can't sleep as soundly at night when they're seeing massive ups and downs in their portfolio. So if you had a portfolio of 100% growth stocks, you'd probably see the volatility be a bit more crazy, like up 40% one week, down 10% the next. It's just a bit all over the place. Whereas this one is meant to give you really consistent returns. So I suppose it's for someone that wants to prioritize like wealth preservation over really aggressive growth. That's kind of what I get from this portfolio. So let's just have a look into this a little bit further. So the stock section, 30% in equity. This can be US stocks. It can be emerging market stocks, any stocks really around the world. And it can be like an ETF. We're going to actually build one of these portfolios in a minute. Then you've got bonds, long and short, and commodities. So I don't know if anyone here has this portfolio and actually does build this portfolio. Personally, I would prefer a much lower percentage allocated to bonds, if any. Like, I'm not really interested in bonds at this stage of my journey. And I don't really feel like I would want any exposure to gold and commodities right now either. So personally, I would go down the more aggressive route and have a lot of stocks and then maybe like a crypto part of the portfolio as well. But I suppose it's personal preference. It'd be interesting to see if any of you guys actually have bonds and what your allocation to bonds are. So let's take a look at, I'm going to try and zoom in here. Oh, I hope that's okay. So let's see how this portfolio has actually performed. So this is data using this portfolio along with other portfolios to compare over a long time period to see what the compound average growth rate, the return on the portfolio is, as well as volatility on the portfolio. So this top one here, this AWP, this is the all-weather portfolio. So what we've just looked at. 60-40 is 60% equity, 40% bonds. That's another really common portfolio as well. And then the S&P 500, I'm sure you know this one, just a portfolio tracking the S&P 500. So interestingly, and I'll let you guys make up your own conclusions here, but the all-weather portfolio, this says 6.95%, but on average, this portfolio is returning about 7 to 8% annualized returns. 60-40 is slightly higher. You can see here 7.91. The S&P is quite a lot higher, 9.95. Okay. Then you look at standard deviation and max drawdown. Both of these things are indicators of volatility inside of a portfolio. Different ways to look at volatility, basically. So the standard deviation is how much deviation there is around a mean, an average. And then the max drawdown is basically how much an investment portfolio is down from its peak to before it recovers. So basically peak to trough, if that makes sense. Maybe go and have a look at a picture of that. I probably didn't explain that very well. But basically, the lower the standard deviation, the less volatility. The lower the max drawdown, the less volatility. So it's doing what it says it does on the tin, right? It's giving you a consistent return. You're getting pretty decent returns, very market average returns, but you aren't experiencing volatility. So you're not really having that pressure to time the market. You're not really having that anxiety. You're not seeing your portfolio go up lots, but you're not seeing it go down lots. So some people might like that. I feel like this portfolio is probably very good when you're nearer retirement, maybe. It's not for me personally, but it's interesting to see and compare anyway. So the standard deviation is a lot lower than it is in the 60-40 and in the S&P 500. Look at the standard deviation in an S&P 500 portfolio. That's quite high. Personally, it doesn't really put me off, but it's quite high. And you can see here, the best year versus the worst year. The best, you're seeing great results, 32.18% in the best year. Amazing. But in the worst year, you are seeing your portfolio hit really hard, and you've got to have a stomach to actually emotionally pull you through that time. Whereas the all-weather portfolio, you are getting some differences here, obviously. And a drop of 19% is quite hard hitting, but it's not as crazy as for nearly 40%. It's nearly half. Max drawdown, again, minus 21.45 compared to these other numbers here. So you can see that it clearly is lower volatility, but lower returns. It's this risk versus reward thing that everything in investing always seems to come down to. And as well, naturally having lower than 50% in stocks is going to actually really reduce the volatility of your portfolio. It's kind of a given, to be honest. So let's just making sure you can still see my screen. Yes, cool. So how would you build, if you wanted this portfolio, how would you do it in the UK? Because Ray Dalio is US based, and a lot of the information online is building a portfolio, an all-weather portfolio from US ETFs and US stocks. So let's build one from the UK. So the first thing, let me put this up a little bit so you can see it. So we need a 30% allocation to stocks. Now, the easiest and simplest way to do that would be to have an ETF rather than picking individual stocks. We don't need just US stocks. We can have worldwide. We can have a global ETF. So what you could have is you could have 30% fully allocated into the VWRL, which is Vanguard's all-world ETF. You're gonna get exposure to everything. Mainly, it's going to be more heavily into US stocks, but you're going to get emerging markets, you're going to get UK, you're going to get around the world, Europe, etc., etc. Or I was thinking what you could do is you could actually split this 30% into 15 and 15. 15 into VUSA, so an S&P 500 tracker, and then the remaining 15 into an emerging market ETF. Vanguard have one, for example. Then we've got the commodity section. So 7.5% needs to be in some sort of physical gold ETF. I say ETF, it's actually ETC, which is exchange traded commodity, basically an ETF for commodities, if you want to look at it like that. So you could put 7.5% into iShares physical gold ETC. That would cover you. Then you need another ETC that covers other commodities, because we saw here that he has this 7.5 into gold specifically, but then 7.5 into other commodities. So you could legal and general, LNG, all commodities ETC. So that could cover you on that front. And again, 7.5%. Then there is this exposure to bonds. This portfolio, in my opinion, is very heavy in bonds, long-term bonds, short-term bonds. 40%, which is the largest portion of this portfolio, is in long-term bonds. So we have this SPDR Spider, you could say Bloomberg 15 plus year gilt ETF. I'm just going to go up slightly so you can see it. So that is one way that you could get exposure to long-term bonds. And then you need a short-term bond. So I found this UK short-term investment grade bond index fund, and that's 15%. Okay, so let me know what you guys think of this portfolio. It seems like it would be good in terms of the uncorrelation between stocks and bonds. So when stocks do well, bonds tend to do worse, and vice versa. So you're going to get that risk balancing and that performance balancing. That could be good for some people. Like I said, personally, it's not aggressive enough for me. So I don't like this portfolio too much, but I do see the point of it as well. So having said that, now what I want to do is I want to actually look at what Ray Dalio in his Bridgewater Associates portfolio actually invests into. So does he follow what he preaches? So let's just have a look. So on here, we can see this basically is a 13F filing. So any public companies have to share what they're investing into. And this is that for his hedge fund. So let's have a look here. I think this is sorted. Yeah, it's sorted by the percentage in the portfolio. So the highest percentage to the lowest. So what I'm seeing straight away is that actually he does have a lot of ETFs. So we got the iShares here, IVV. That's a S&P 500 ETF. Then we've got this IEMG, which is an iShares emerging market ETF. We've got VWO, which I believe is another emerging markets. Let's just have a look at that actually. Emerging markets, yep. Okay. And then we've got SPY, SPY, again, a very, very popular S&P 500 ETF. So he has got, and here you go, gold. This will be his exposure to commodities. I'm sure we'll see some more stuff like that. So he does seem to have exposure to commodities, which we saw. I haven't seen any bond exposure yet, but I'm sure it's in here. But one thing I'm wondering is, why does he have the same ETFs? So he has 2 ETFs that track emerging markets and 2 that track the S&P. I think what's happening is, so he's reducing his shares in, where is it? This one, VWO, but he's increasing them in IVV. So I guess, this is an assumption, check this out. I guess IVV has a lower expense ratio. It's probably cheaper. Therefore, he's putting more money into that and reducing it elsewhere to make the portfolio cheaper to run, I imagine. We've also got Procter & Gamble, massive, massive companies with some very, very known household brands. That is quite a big percentage of his portfolio. Massive US company, operate globally. Johnson & Johnson's an interesting one, actually. Let's just look at that on Seeking Alpha quickly. If you're interested in Seeking Alpha, by the way, I'll leave a link in the description. It's fantastic for US stocks. It literally tells you everything you need to know. Yeah, so they're not having a great time at the moment. You can see, look, minus Okay, 6 months is okay, but year to date, minus 7.3, minus nearly 10%. There's a whole, this is one of my favorite things about Seeking Alpha, actually. It tells you the latest news on every company. There is a lot of stuff going on about a lawsuit right now. You can see here, bankruptcy, litigation. So that's probably why the stock's down. Interesting to see quite a large percentage of that still in that portfolio. However, it is also being decreased. Perhaps that's why. We've got Pepsi here. Again, a massive, massive company. You know, lots of these companies are in a lot of successful investors' portfolio. You know, look at Berkshire Hathaway. You'll probably see a lot of the similar things, especially with Coca-Cola, Walmart, McDonald's. This one's interesting, actually. So I don't know much about this company, but I do know that it's a Chinese-based stock. And there's been a lot of stuff, you know, going on with Chinese stocks. So that's interesting to see because that's quite a big percentage, like 3.65 million shares he owns of this. Some other really big companies. He actually has a stake in Berkshire Hathaway. That's interesting. So it does seem like he is, another gold one here, he is following his own advice to a point. I don't really see that much bond exposure in here, but I'm sure if I looked hard enough, I probably would. So that's quite interesting. Let's now just go back to my little document that I made. Look at this performance here. This is obviously just one snapshot of performance, but I'm not sure I don't know if I would give up the higher growth and the better returns for the sake of less volatility, in my opinion. I don't know. Let me know what you guys think. But anyway, I'm going to come over to have a look at some questions and stuff, what you guys are speaking about, because I just went off on a little ramble and I need to catch up now. By the way, anyone watching here from the UK, have you gone with a new ISA provider or are you sticking with the one you got? Let me know. Let me know. And if you are interested in trying trading 2-on-2, I'll leave a link in the description. You don't have to open an ISA if you've already got one. You can just open an invest account with them. But basically, if you use the link, you'll get a free share and I'll get a free share. So, you know, a nice little Easter treat, some free money. Oh, greetings from Canada. I do love Canada. Hello, hello. Oh, this is a nice comment. Yeah, I recently did a video with Russ on Dapper dividends. It was a really, really cool talk, actually. So if any of you want to go and watch that, please do. He was such a great host. And it was, yeah, we've got into lots of different like mindsets of investing and tips and things like that. So it was really interesting. So definitely check out his channel. I think there's a better portfolio for people in retirement. Yeah, I 100% agree. If I had to pick between this portfolio, so the all-weather portfolio, and maybe a 60-40, I still don't know what I would pick. My problem is that right now I'm in this growth stage. So I'm in the exponential stage of my portfolio growth, which means I want as much aggressive growth as I can get. And I personally just don't see that possible with bonds. So I don't know. I don't feel like I would know what to go with. Maybe the 60-40, but then I wouldn't get commodity and I'd get a lot of bonds. Yeah, I think 60-40 because that gives you less exposure to bonds than this portfolio does. It's a portfolio to preserve what you have. Yeah, exactly. That's what I think. It's a wealth preservation portfolio. So I feel like what you do in investing is you're at your growth stage and you aggressively get as much money as you possibly can as quickly as you can, because that's pretty much what we're all here for. We want our investment portfolio to get us money. And then when you're nearing retirement, you switch and you try and preserve that wealth for as long as possible. So it like exponentially grows, and then you're like trying to get the horizontal growth, you know what I mean? Because you want to preserve that wealth at that point. And that's why a lot of people as well switch to dividend investing at that stage of the journey, because they need an income from it. They're retiring, they need to withdraw money, and stable dividend growth companies tend to be quite popular. I love this, Adam. I love this comment. Yes, this is so true. And it's crazy how impactful like your emotions are on your investing. If anyone here has read the book, The Psychology of Money, we were speaking about it in my Discord earlier, actually. Let me know what you think about that book. I think I might try and get my hands on it, or like an audio version, but it's very, very true. Hey, Belly Pork. How's it going? How were your fish and chips? Let me know. I don't actually have new hair color. Sorry, Gary. Maybe it's the lighting. I have not dyed my hair. This is a very funny comment. It's great to see so many of you joining. Thank you so much. So the ISA in the UK is our tax efficient account. So everyone in the UK has the ability to open a stocks and shares ISA, and it allows us to invest up to 20,000 per year without paying tax on capital gains or dividends. So it's a really important account. So please prioritize investing inside of an ISA. Is it the same as a 401k? I'm not entirely sure, but it's our tax efficient account. I'm with you, Eddie. I'm not really interested in commodities at the moment either. I might look to introduce some commodities as I get further on. But right now, the way I view my investing is, where is my money best spent? Where am I going to get better returns? And if I think about commodities versus bonds versus equity versus crypto, for example, I'm leaning towards that end of it rather than the more conservative side. Open AI tech has got to mean a productivity boost for knowledge-based work this coming decade, right? That's where I'd invest. Yeah, I'm with you. I think AI stocks are a very interesting sector right now. Something that I'm looking into for sure, because I do think it's the future. I'm also trying to find a stock or an ETF that is specifically for genomics and personalized medicine, because again, I think that's going to be a big thing in the future. Haven't found one yet, and I'm not exactly in a rush. I'm not going to let FOMO get to me on that one. But yeah, I do agree with you. 100% agree. It's going to change with your age. Definitely going to change with your age. Does seem like this. It does. What are you guys investing into at the moment? Hey, I'm glad you got a free share from me. Happy Easter to you. I hope it was a good one. Let me know. What was your free share? What did you get? And thank you for using the link, because that means I got a free share as well. So appreciate that. Oh, we've done that one already, but I do agree. You're sticking with Vanguard. Nice. I feel like Vanguard is a popular one for good reason. What have you got in your Vanguard portfolio? Let me guess. I'm going to go with, you've got VUSA, and or my second guess is going to be VWYL. VWRL. Let me know if I'm correct, Paul. That's my guess. Okay, so you've gone to trading 2-on-2. Nice. I hope you enjoy trading 2-on-2. That's my provider this year. If someone wants a low drop down, then it's a good portfolio for such investor risk tolerance. Yeah, it's going to depend on risk, isn't it? Yes, I will. I'm actually doing a series at the moment, which is basically where I build hypothetical portfolios, and this will be part of that. And I will share my trading 2-on-2 pie so you can follow it if you're interested. I just need to get around to actually doing that. Free trade is good. I've been using from last year. Do you think I'm okay to continue? I mean, yeah, if that's the platform you want to be on, that's absolutely fine. I think a lot of people are worried about free trades increases in the price, which obviously will eat into your investment return. So something to think about. But yeah, ultimately, it's a personal decision. You've got to decide where you want your money and what platform you want to use, because different platforms offer you different things. So, for example, Paul with Vanguard, he can only invest into ETFs, but if he wants to only invest into ETFs, Vanguard is a fantastic option because of the low fees, great funds, etc., great customer service. So it really just does depend. 50% VUSA and 50% All World. Been thinking of adding bonds, but I like the stocks. Yeah, that's a great portfolio. You're really diversified there. I feel like don't add bonds if you just feel like you should. Only add them if you feel like they have a place in your portfolio. Thanks, Gary. I will get my hands on that book. We've been speaking about it in Discord a lot, and yeah, it looks to be a good one. Great question. Great question. Do I have a retirement goal or age I'd like to retire? I don't have like an age necessarily in mind, like a specific age. Ideally, I want to get to financial freedom as quickly as possible, but it's only to buy my time back. It's not because I don't like my job or anything like that. It's purely I want to get to a state where I can decide how my time is spent. So if I want to work on this channel, then it's still work, but it's my choice. If I want to spend a whole day reading investing books, again, it's my choice to do that. That's kind of what I want when I say I want to retire early. That's what I mean. I don't mean actually do nothing, because that sounds like hell to me. So I'm 27 now. I don't really want to be in a traditional job past the age of 40. I'll say that. I don't know. My mind changes all the time, but ultimately, I'm investing so I can get myself a better financial future. Ooh, that's nice. You got a free share, 10.50. There you go. That's your Easter present from me to you. I love that you do this every time. Thank you for giving me this shout out, because I always forget. Yes, smash the like button, share the channel with more people. I want more people to be motivated to invest, even if they are starting from zero knowledge and like very little money, because I think people can be put off investing because they just don't know. They don't understand. It's confusing. It's gambling. It's too much to learn, and they don't feel like they have enough money to actually be able to invest. That's the stigma that I want to remove. I want everyone to have a shot of financial freedom, because they don't teach it in schools and they don't teach it anywhere. And it's really annoying. Off on a tangent. Enjoy the rest of your day and enjoy your Easter. I agree. Not sure what that stock was. I never heard of it, but I put cash. Yes, you shared this on the Discord, didn't you? So you've shared your new portfolio, and I'm very excited for you. Oh, I nailed that one. I said you invest into VUSA and oh no, I didn't. I didn't nail it. Okay, I got one third correct. So you actually invest into an S&P 500 ETF, a high dividend yield ETF, VHYL, and V3 AM. Is that an emerging markets one? Can't remember. Yes, belly pork. Again, you shared this with me as a Patreon member. I was very excited to see this for you. It was an incredible dividend payment. Honestly, amazing job. I can't wait to see what you've got in the future. I like that people are liking trading 212. I'm really, really enjoying trading 212 at the moment. I'm investing pretty much every week at this stage. So yeah, it's like literally every week I'm investing. I can't make invest with me videos every time I invest. So what I tend to do is I do like one big invest with me video, and then the little investments in between that I make, I'll share it with my Discord and my Patreon. I can't keep up every single week. I'll leave this one for anyone else that wants to answer. I'm not finding any issues right now, but I've also not been on the platform that long. So I don't want to say no, definitely. I've found it really simple to use, really easy, really nice, cheap, etc., etc. Has everything that I could want to invest in. So I'm enjoying it. I use the app on my phone, but I also use the desktop version. So maybe they've made some updates since the reviews were put on. I'm not sure. But if anyone has anything to add, do let me know or let them know. Hello, Hayley. Looking forward to setting up my first ISA. Use my link. Use my link because in the description below, when you set it up, you'll get a free share, which is literally free money. So please use that. Or use if you want to use a different, YouTuber's link, then fine. I just want you to free money. Any thoughts on me going with VUAG? I'm not even going to say all of these. Let me just check which each one is, and then we can see. I'm not a financial advisor, though. Please know that. This is just my opinion. I cannot give financial advice. So VUAG is an S&P 500 ETF. So like VUSA, except it's an accumulating one. So instead of paying you dividends, they will automatically reinvest. So less for you to do. S&P 500, in my opinion, is one of the best ETFs that you could possibly have. And then the next one is FTSE All World ETF. Okay. So, and let me just check the last one before I say anything. And then you've got a FTSE 100 accumulating fund. You're definitely going to have overlap, but it doesn't necessarily mean that's a bad thing. So I don't know. It depends how you want to look at it. You could look at it as in you're going to have some overlap and it might not be worth paying for all these different ETFs when you could just get it all in one global ETF rather than paying for 3 different ones. But equally, they are going to give you different exposures. So VUAG is going to give you those massive American companies that operate globally, but they're massive American companies. And then VUKG is going to give you the biggest UK companies. So those are very different. It's the one in the middle that's going to be the one that overlaps with either side. Doesn't need to be a bad thing because the VWRP is going to give you exposure to the rest of the world that you're not going to get through FTSE 100 companies or S&P 500 companies. So it's going to give you exposure probably to emerging markets and areas like that you might want. So what I would do is, if I were you, I would think about what sort of companies and what sort of markets around the world do you want exposure to. And if you specifically think that you want 50% UK, 50% US, then cut the middle one out. But if you think you want your toes in everything, which is fine, then, it probably is a good thing to do. So I wouldn't worry too much. Purchased £1,000 of Tesla at nearly £195 per share. Noticed you did 700 with your last Tesla investment. How should we feel now that they are about 185? Okay. Tesla stock, in my opinion, is, it's one of the ones I have the biggest conviction for. I just see Tesla becoming absolutely massive, bigger than they are, and that will be reflected in the share price eventually. However, with Tesla, it tends to be a very volatile stock and it tends to be really misunderstood by stock market analysts. The people that are used to valuing companies like Procter & Gamble, Unilever, these companies that are really established and really understood are the same people that are trying to value the newer companies, the Palantirs, the Teslas, the companies that are innovating and disrupting sectors. And they are struggling with that. And any news that comes out has a really quick share price knock on. So what I would say is, if you are going to invest in Tesla, just try your best to understand that the stock price will go up and it will go down. That does not mean that the value, the intrinsic value, so how much Tesla is actually worth as a company, is also going up and down like that. It's just the noise. It's the noise around the company. So just get used to seeing that. And try and think about why you want Tesla in your portfolio. And if you have a strong enough conviction for it, then just don't worry about it. Honestly, if anything, just see it as a time to buy more. That's what I do. Sometimes I buy a stock and then the next day it's gone down by like however much. And I'm thinking, oh, I would have got more shares if I waited. But trying to time the market is difficult, and it's probably not a useful strategy. So I wouldn't feel anything about it, to be honest. I would just think, well, I'm buying a good company that's going to be one day worth a lot more. So hang on in there. That's my opinion anyway. BBH. Okay. Noted. I will check that out. BBH. Cool. Thank you. Would this all-weather fund require a lot of rebalancing? Yeah, probably. Probably. Whether you would want to do that, again, don't know. But yeah, any portfolio where you are specifically aiming for a percentage in each category. So you want 40% bonds, 60% whatever, or you're going to go even more niche than that. And you're going to say, I want 10% in consumer goods, 10% in technology. It's going to go out of that all the time because you're going to get overexposure to one, underexposure to the other, and you're going to have to go in and rebalance. Rebalancing is a really interesting thing, actually, because I think quite a lot of the time people don't realize that rebalancing is going to come at a cost. And I don't feel, again, I'm not a financial advisor, this is just my opinion. I don't feel like rebalancing for the sake of rebalancing is a good thing to do, because you're paying money for a start. And let's just say, right, that I had a portfolio and I wanted 50% of that to be in technology companies, and I wanted 50% of it to be in consumer good companies. If that then went out of balance, I would then feel like I would have to bring it back to the percentages. But what if I suddenly realized that the technology sector had way more opportunity and I was purposely not investing in that sector, but putting it in this sector because I wanted it balanced? It doesn't make sense. Just invest in what you have strong conviction for. But yeah, it would need rebalancing. It would. We've got another Tesla fan in the house. Joe Jordan, I don't know if you were here for a previous live stream, but someone said, imagine if Elon Musk walked through this door. I'm still waiting. I might tweet him, try and get him on a live stream with me. Wow, that would be amazing. Only invest in index funds for SIP and work pension. For ISA, I invest in ETFs and stocks, plus some day trading. Oh, you're brave. You're brave. You are brave on that one. That feels like a long time. Yeah. Basically, if I'm being really honest with you, I want this YouTube channel to be something that I do full time because I'm obsessed with it. I love, love, love talking about investing. I just need to get it to a point where it is a full-time thing, and then I can just put everything I have into it. So that's what I'm trying to do. But, small steps. Okay, cool. Thank you for letting me know. And ESG, how do you guys, obviously, Paul, I guess I know how you feel, but how does everyone feel about ESG and like investing into more ethical, environmental friendly stuff like this? Any investments you think we should avoid? Yeah, I mean, there's loads of things I think you should avoid. Don't go with companies just because they pay a high dividend yield. That is normally a way to lure people in, and quite often there's going to be hidden things there that probably aren't that great about the company. I'm trying to think of a specific stock. I'll have a think. I don't know any off the top of my head that I personally would say avoid, but obviously like the obvious ones, the pennies, like the really meme FOMO sort of stocks, stuff like that. Let me know. Come and tell me what free share you got when you get it. I'm excited for you. I'm reading How to Get Rich. It's not a book about investing per se, but more of a way to look at things as a whole. Okay. How to Get Rich. I will note that. There's probably people on my Discord that have read that, so I'll ask about it. But thank you for the recommendation. I like most books, to be honest. Anything that will provoke a thought. So right now I'm reading a book. I always forget its name. It's called A Guide to Wealth and Happiness, and I'm halfway through it, about halfway. It's incredible. It's made me, every single page has given me like 4 things to think about. Only issue of trading 2-on-2 was then pausing during the GameStop volatility. Yeah, I mean, I wasn't around during that time on trading 2-on-2, but I can imagine it was pretty crazy. Pretty crazy. Do you think it's time to buy the housing stocks like Taylor Wimpey, since the housing market is not doing good? Yeah, I mean, you could view it like that if they're at a bit of a discounted price right now. They don't feature in my portfolio because I just feel like my money is better spent elsewhere. But you could view it like that, as the time reflected to the housing market. What are Palantir? Palantir is one of the most, I think, I don't want to say misunderstood companies, but a very, very confusing company for a lot of people, and rightly so. I could be here forever if I try and explain what Palantir is to you. I will make a whole video on Palantir because it's quite a big portion of my portfolio and one that I'm adding to. So I want to make sure that I'm talking about it, and I think it could be helpful for other people. But essentially, it's a company that I have in my portfolio and that I'm feeling like will do well in the future. They're basic right at a very, very overview level without getting carried away here. They're basically a company that they have software and they're trying to change the way that government and commercial companies are handling their data in order for it to be more efficient. I'll leave it at that because I'll be here all day. But yeah, go and have a look into them, see if you're interested. I sold Tesla at 207 and completely dumped Tesla until it reaches it's time to buy Amazon and Google. I love Tesla, so I'm not going to get rid of my Tesla stock. However, that's probably a nice profit that you made there, and I completely agree with Amazon and Google. If you guys have been watching my portfolio, my Invest With Me, you'll know that I've been buying into those 2 companies as well. Phil, hi Phil, how are you doing? We've been missing you on Discord. I hope you're all good. Investing is interesting. Absolutely. 100% agree. I wish they would teach kids at school. I mean, kids aren't going to be interested in investing necessarily, but there's got to be a way to start making it interesting. I'm seeing conversation between Discord members here. I love to see it. The EV stocks are taking a hit because the consumer market is taking a hit due to secondhand. There you go. You heard it here first. I do agree the EV market is expanding, and I think that's a really good thing. I think Tesla having competition is not a bad thing. I feel like they are years ahead of other companies. Their profit margins are insane. They're just making things cheaper, and I'm all for Tesla having competition, honestly. And I've seen some really nice electric vehicles around that I would love to own. But as a business, I want to invest into Tesla. And I don't really think that. So I don't invest into Tesla because of its EV business. I invest into Tesla because of everything else it's doing, plus its EV business. We've got some conversation here. We've got some conversation. How's you and your portfolio going? Okay. Yeah, my portfolio is going well, Phil. I'm going to actually record a portfolio update video tomorrow, but have a look on Patreon. I've posted, or on Discord, you're on there as well. I've been posting about how my portfolio is doing every single Friday. So if you want to look, go and look, or I can let you know on Discord how it's going. But yeah, it's a bit like this at the moment because I have like growth stocks in there, so they're going a bit crazy. But good to hear your portfolio is doing well. Oh no. Imagine how viral the video would go though, Ocean, if he did walk through. Not a fan of the ESG stuff. Okay. How come? Is it because of the returns? Or yeah, what's it because of? Let me know. I personally don't have really an interest to invest, but I'm not against it per se. Persimmon high dividend yield seems to be safe. Yeah, there's definitely companies that have a high dividend yield that have been able to keep that dividend. So I think, do you know what, Belly Pork? I think you've hit the nail on the head here. It's not necessarily about high versus low being good versus bad. It's about looking at if the company is able to sustain and then grow their dividends. That's the important thing, because thinking about some companies, let's think about Legal and General. I don't know, something with a typically high dividend yield. Just because they've got high dividend yield doesn't mean they're bad. You need to see if they've been able to keep that dividend growing or keep it consistent over time. And then look at their balance sheet as well and how that all interacts together. And that will give you a better indication on whether it's a company you want to invest in. So yeah, I don't even know if you meant that, but great point. Yeah, I like this, Phil. I think I invest into some companies that are quite confusing, like Palantir, but I wouldn't invest into a company that I didn't take time to understand first, because I think that building conviction for a company is so important. So I do agree with you here. A lot of my neighbors drive Teslas. Yeah, not me yet, unfortunately, but maybe one day. I've been unwell recently and I can feel my throat getting really scratchy. So I'm just going to have a 5-second break. BAE System is a good company. Yeah, it's one of my favorite UK dividend paying companies, actually. Okay, I think what's my favorite UK dividend paying company? The ones that come to mind are Unilever, Diageo, BAE Systems, maybe Legal and General. They're the ones that come to mind anyway. We've got a lot of people saying different things about Elon Musk. We always end up on the topic of Elon Musk on these conversations. Get in there. Good. Just keep being consistent, Phil. That's what matters here. That's what matters about anything in life, really. Okay, I'm going to start wrapping it up in a second because excitingly, actually, I have 2 videos coming out tonight. We're going to post one very, very soon. So check out that. It's going to be all about what millionaires have inside of their ISA accounts. And it's quite surprising, actually. So watch that. I'm going to post that within the next sort of 5 minutes. Go and check that out. Comment saying that you were here. And then later on, I'm going to post a video about a new stock that Warren Buffett's adding to his portfolio. So again, keep your eye out for that. I can promise it's not that. Right. Let's start wrapping it up. Thank you. Thank you. Thank you. I'm just going to do this one and then I'm going to wrap it up because I've clicked on this. I have a list of 9 companies I'm watching. Haven't pulled the trigger as of yet. Okay, cool. Sam, let me know. Samuel, let me know what companies they are. I'm going to be interested. I don't. No, you haven't said. Okay, yeah, let me know what companies they are. Maybe leave me a comment on a video and tell me what they are because I probably won't see it on here now. Thank you, everyone, for joining this live stream. I hope it was interesting. I hope it provoked thought. Like I said, I'm going to be posting a video right now all about what millionaires have. Oh, it's gone live. It's gone live. So go and check out that video. Thank you so much for watching, and I'll see you again very shortly.